So the last few weeks have really been about two things. It's been about trade and it's been about tech. Both of these have had a negative impact on sentiment in financial markets and potentially on the global economy more broadly. The focus in the tech sector has really been about Facebook, Cambridge Analytica, and the use or abuse of user data. And it's an important issue for financial markets for a couple of reasons. The first is around changes in user behavior. Will users interact with these businesses differently going forward, and what implications would that have for the speed of their profits growth? The second is around regulation. To what extent will governments move more aggressively to regulate what they perceive as some of the excesses of these platforms? From a financial markets perspective, both of these considerations are broadly negative. Perhaps these businesses will not grow quite as quickly, perhaps their regulatory environment will be more difficult and their profitability will be constrained. But it seems likely that in any event, these will continue to be strong, powerful, growing businesses, and at the right price will look interesting. The issues around tech are really about the price of the financial asset. The concerns around trade are more fundamentally about global growth. What we're seeing is a gradual escalation in the rhetoric and the action from the US and China specifically. And over time, what you would expect is, on this trajectory, that we would see a negative effect on global growth and potentially higher inflation, not perhaps over the next 6 months, but over a longer time period. Now, it's too soon to say that a trade war has arrived, and it's reasonable to expect that there will be some measured responses for both sides. Neither of them is keen to see a sharp deceleration in global growth. And all, I think, recognize the opportunities that come with global trade. So when you think about portfolios and portfolio positioning, we're not yet ready to make a very aggressive move defensively, even though we've seen markets weaken, because we continue to see some relatively sound fundamentals. But we do need to continue to monitor the situation to make sure that our starting assumption of a measured and proportionate response from both sides continues to hold. So it's been a weaker quarter in financial markets than we've seen for a while, and equity volatility in particular has risen. From a portfolio perspective, we've seen some of that weakness reflected in our portfolios, but interestingly, the volatility of the portfolios hasn't picked up significantly. This suggests to us two things. Firstly, that our relatively conservative positioning has helped us a little bit, and secondly, that diversification has worked in our favor. Now, clearly, we need to think about markets going forward and the implications that that might have. We're still fundamentally positive about the long term. We think that the underlying fundamentals remain good, even though we recognize some of the challenges. We do think, though, that market volatility has probably moved to a new higher level after a very, very low 2017. And that has implications for how we construct portfolios. We recognize some of the risks around tech and around trade, but so far we're not in a rush to cut our overall positioning or take risk off the table.